Hi, everybody, and welcome back to video number 8 in chapter 13. And when we left off, we were looking at example 1, where we had no gain for a debtor. We had bank restructurings from $10,500,000 to $9 million, an extension of a maturity date, and a reduction of interest rates from 12% to 8%. And now their calculations, here's our carrying value of the note, $10,500,000. And so we do this the same way we always did. We take what's written on the note, which is 8%, right, times $9 million. And that's going to give you the cash that's going to be paid. The interest expense, we're going to take the carrying value times the factor, which is 0.0346613 here. And that is we're going to have a reduction of carrying value of $356,056. And that's the difference between $720,000 and $363,944. And that will reduce the carrying value of the note to $10,143,000. As of December 31, 2025, then, we're going to debit notes payable for $356,056. We'll credit interest expense or debit interest expense for $363,944 and credit cash for $720,000. All listed there on the calculation spreadsheet. Now, as of December 31, 2028, we're going to do a lot of the same things. We will debit notes payable to zero that out and credit cash to pay for it. Because as of December 31, 2028, the carrying value of the note is down to $9 million. Okay, the creditor has some different calculations here. The pre-structure carrying amount was $10,500,000. We take $9 million here, 4 years at the effective interest rate of 12%, right? We'll pick that up from table 6.2 and multiply through. Do the same thing for the $720,000, and we get that from table 6.4, 4 years at 12%, and that gives us $2,186,892 for a total of $7,906,572. Therefore, the loss on the restructuring is going to be $2,593,428. And we will debit bad debts expense for $2,593,428 and credit the allowance for doubtful accounts for $2,593,428. And now the schedule of interest and amortization is still the same. We're going to debit cash for $720,000. We're going to debit an amortization of the allowance for doubtful accounts of $228,789 and credit interest revenue for $948,789. And those calculations for the $948,789 is going to be this carrying value of $7,906,572 times 12%, just like we've been doing in effective interest calculations. Okay, the creditor makes a similar entry except for differing amounts debited to the allowance for doubtful accounts and credited to interest revenue each year until maturity. And at maturity, the company is going to make the following entry as the creditor. We'll debit cash for $9 million. We'll debit the allowance for doubtful accounts for $1.5 million and credit notes receivable to zero it out for $10,500,000. All right, so now in example 2, this is a gain for the debtor. We're going to assume the facts in the previous example, except that Morgan National Bank reduces the principal to $7 million and extends the maturity date to December 31, 2028, and reduces the interest from 12% to 8%. The total future cash flow is now $9,240,000. $7 million of principal plus the $2,240,000 of interest, which is $1,260,000, representing the $10,500,000 minus the $9,240,000, less than the pre-restructure carrying amount of $10,500,000. So under those circumstances, Resorts Development, the debtor, reduces the carrying amount of its payable, $1,260,000, and records a gain of $1,260,000. On the other hand, Morgan National Bank, the creditor, debits its bad debt expense for $4,350,444. And here are the calculations for that. Here's the $10,500,000. That $4,448,640 is computed by taking the present value from table 6.2 for 4 years at 12% times the $7 million, and that gives me that $4,448,640. The present value of the interest annuity, we're going to take 4 periods at 12% from table 6.4 and multiply that factor times 560,000. That gives me 1,700,000. Together, that represents 6,149,556. Subtracted from 10,500,000 gives me the creditor's loss on restructuring of 4,350,444, as we showed on the previous slide here. So the journal entries, as shown, we have the notes payable for the debtor. We're going to zero that out and show a gain on the restructuring of debt of $1,260,000. And then for the creditors, we'll debit bad debt expense for more $4,350,444 and credit the allowance for doubtful accounts for the same amount. Okay, so here's a schedule of that amortizations, how it goes from the carrying value of $6,149,000 up to the $7 million at maturity. And that's calculated in the same way that we've been doing these effective interest calculations. The interest revenue in this case is based on 12%, but the cash received is based on 8%. Okay, so here the debtor is going to debit notes payable and credit cash. That'll zero that out, and we'll pay the cash for $560. At the end, we'll do the same kind of thing. We'll debit notes payable and pay off $7 million in cash. For the creditor, the cash that they receive is going to be $560,000, but the allowance for doubtful accounts will be $177,947, and interest revenue will be $737,947, is shown on this effective interest spreadsheet. And then at the end, we'll get cash for $7,000. We'll debit $7 million. We'll debit that. We will get rid of the allowance for doubtful accounts with the debit, and credit, zero out notes receivable for $10,500,000. All right, let's look at accounting procedures for long-term liabilities under GAAP and IFRS. Here we have several similarities, as indicated in earlier discussions. GAAP and IFRS have similar liability definitions, and liabilities are classified as current and non-current. It's also similar that much of the accounting for bonds and long-term notes is the same for GAAP and IFRS. Under GAAP and IFRS, bond issue costs are netted against the carrying amount of the bonds. Differences, there are several. One, under GAAP, companies are permitted to use straight-line method of amortization for bond discount or premium, provided the amount recorded is not materially different than that resulting from the effective interest amortization. However, the effective interest method is preferred and generally used. Under IFRS, it's mandatory that they use the effective interest method. Under IFRS, companies do not use premium or discount accounts, but instead show the bond at its net amount. For example, if a $100,000 bond was issued at 97, under IFRS, the company would simply record cash at 97,000 and bonds payable a credit of 97,000. Under bullet point 3, under differences, GAAP uses the term troubled debt restructuring and has developed specific guidelines related to that category of loans. IFRS generally assumes that all restructurings will be accounted for as extinguishments of debt. And last bullet point, IFRS requires liability and a related expense or cost be recognized when a contract is onerous. Under GAAP, losses on onerous contracts are generally not recognized under GAAP unless addressed by industry or transaction-specific requirements. All right, that ends Chapter 13. And when we return, we'll take a look at Chapter 14. Until that time, bye for now.